Thank you everyone for coming to our first webinar of the year. What the investor is looking for before investing. Before starting, give me 1 minute to explain what is EquityMatch and what we're doing. EquityMatch is my dream coming true. It's been always my dream, coming from the private equity to the venture capital, having something to share, not only cash, but knowledge and connections with founders. That's why I've been seriously driving and writing from A to Zeta EquityMatch during the pandemic. All deals were interrupted. And after today, we are here. What we do, we try and we connect startup with investors. We create events and we aim to become a media platform where we can not only creating connection between founders and investors, but we want also give tips, advices, trying to bring the venture capital ecosystem together. We decided to run also a few webinars during the year. We have pretty much every month one webinar, one pitch day. Webinars are today we're in a webinar talking to great investors in front of me about exactly what they're looking for in a startup before investing. But also we are going to have more other webinars during the year, more related to specific sector like healthcare, crypto, and so on. You can see all our calendar on our website, but also we're going to share on our social and others. Now, I don't want to take other time, and I would like to welcome our beautiful panel of investors. And let me start with Stephanie Tumba, founder of Steve Tumba Capital TD and Seed and Series A investor. Please, Stephanie, introduce yourself.
Hi, I'm Stephanie Tumba. I'm the founder of Steve Tumba Capital and the co-founder of Steria Club. So we invest consciously in startup Series A, and I'm looking for amazing ideas that change the world.
Thank you, Stephanie. Now, when I first met Francois was years ago, is a guru in this sector. Francois is an entrepreneur, investor, and advisor. Please, Francois.
I go with an introduction like this. I can only disappoint now. So I'm Francois. I've been in 8 technology startups. I've had pretty much every job. I've had the IPO on the NASDAQ, and I thought it was cool. We built an accelerator and venture builder, and we had 4 IPOs in Stockholm. We thought we were super cool. I had the bankruptcy that took it all the way. And since then, I'm an investor and an advisor. I run 2 small businesses. One is a physical space in South London, which is the largest anywhere south of the river. And the second one is called the Fundraising Bootcamp, which is really what I'm here for, which takes scale-ups and startup CEOs to the very best investors, like the ones that you have on the panels today.
So let me introduce you Jonathan Pacifici, much easier because Pacifici is Italian surname. For me, it comes easier to say. General partner of 6 Millennium Venture Partners. Please, Jonathan.
Hi, thank you for having me. I'm Jonathan. I was born and raised up in Italy, indeed, in Rome. Living in Israel since 97 and experienced the boom of the tech industry in this wonderful country. I was a management consultant for many years, taking Israeli companies abroad and doing technology scouting here for international corporations, then moved to the VC industry and started my first vehicle, Vadi Ventures, where we invested in fantastic early stage companies here in Israel, and now starting 6 Millennium, our new fund, also in early stage domain.
Thank you, Jonathan. And now let me close with Edward. Edward is partner at Sofinova Partners.
Yes, I'm a partner at Sofinova Partners. We're one of the oldest venture firms in Europe. We're celebrating our 50th anniversary this year. And I'm responsible for healthcare technology investing. My activities are mainly focused on pre-seed, seed, Series A, and building those companies forward.
Thank you, Edward. Now, today we talk more broadly about venture capital, early stage and seed stage funding. And I would like to start with the first topic, which is probably the most, let's say, generic, but it's very important for all our attendees. Are most of them, they are seed, pre-seed, very early stage founders. So I would like to start. Let's give to Stephanie, which is the only woman here today between us. Let's start with Stephanie. And after we can start discussing one by one. What do investors look for before investing? What do you look for before investing in startups?
I would like to start with idea, but it's much more, it's much more than a great idea. We're searching for a right fit in terms of personality, in terms of even ambition for the business, obviously the location, the mindsets, the market size, and of course the credibility and and some social proof as well for the startup. That would be the ideal package that I would be interested in. But more importantly, I am like 100% on the personality of the funder. I have to get on with him or her on that matter, and be sure that we're looking for the right things for the business as well. So that's very important for me, like in terms of that, because even sometimes you have an amazing idea, but if the funder and everything else and the team, in fact, as well, is not a great fit, that won't go anywhere.
What about you, Francois?
So we've seen hundreds of companies. We've helped, over 112 with going all the way through their process. There's two things that I would summarize with. The first one is the team, because it changes everything. You'll see, I can explain why. In short is, the first time you do this, it's a bit like your first rodeo. You're most likely going to make every single mistake in the book, and therefore that's going to be very costly, and nobody wants to be picking up that check. They want to come right after you've made the mistakes so that they finance your growth, not the early stage mistakes. So the team, and ideally a mix of repeat team with fresh new ideas and execution capability is what everybody's looking for. Number two, I think, is it a true VC opportunity? Everybody thinks they're backable. There's plenty of capital in the market today, but very few companies actually and can produce VC size returns. And that's when a lot of entrepreneurs go wrong. They have amazing, great businesses that go profitable very quickly and then plateau. Typical example for me is e-commerce. You can go from 0 to 2 million euro and profitable relatively quickly. Some of them do this under 2 years. But then good luck going from 2 million to 20 million to 50 million, which is where you need to be if you want to have a multiple of X to 20. And so you have a lot of companies that start well, but just are not VC territory. They're great. There are other forms of capital for them, not venture capital. You need to be massive. So these will be my two: team quality, and are you really a VC size return business?
I really would like to come back to this question, because exactly, I do believe many funders, they really are not into the venture capital ecosystem. Actually, rules are inside the venture capital sector, because you can have your startup going with your money growing, right? You don't need to grow 10% per week to be so scalable, becoming a unicorn or something similar. This is something I really like. I'd like to come back later. Jonathan, what's your point of view?
Oh, I totally agree concerning the issue of the team. For us as well, it's extremely important. We invest in Israel, and that's probably takes me to the point that the definition of startup, it could be misleading in many countries. For example, in Italy, quite of experience in Italy as well. In Israel, for example, we invest in enabling technology companies. So anything which is e-commerce or companies, that the kind of companies that we mentioned before, will not get VC money. And the reason is exactly the one that Francois mentioned. The difficulty in achieving VC great results with this kind of companies. On the other hand, once you invest in a company that owns an IP, an enabling technology that can be at a certain point, they are just an IPO or can be acquired. In Israel, for example, we have a quite large M&A market. and companies like Google, Facebook, Intel, and many others are buying companies every day. And they basically are buying a technology, and so if you don't have a technology, enabling technology that can be generate hundreds of millions, if not billions, you know the kind of investment that the VC is looking for. Maybe it's a terrific business, but it's not for VC. And in terms of the team, again, definitely the team need to be balanced, need to be experienced. Here in Israel, for example, since all of us do the military service, is extremely important. To the first question that you ask, where you served in the army, and this will tell you quite a lot about the kind of people you have in front of you.
Thank you, Anton. Edward.
Yeah, I think what Francois mentioned before, that's the key, right? The key for us is the team, and therefore the self-awareness of the team. And what that means is venture capital and funding is not a goal in and of itself. It's a means to an end. And a very big mistake that we see oftentimes is people regarding the next funding round as the objective, but it's not. And so as a founder, you have all these different tools in the shed to basically get to where you want to go. If you want to build a good life for yourself, but you don't want to conquer the world, by all means, don't take venture capital, because we're imposing rocket fuel like return expectations on you. And that's really, it's almost draconian. So if you sign a deal with us, we expect you to really scale this thing to the moon and sacrifice everything for it. Now, if you don't want to do that, by all means, take a bank loan. There's nothing wrong with that. And so this is really the key. The self-awareness, understanding where you want to go, understanding what you have, and understanding what that journey takes. And we're helping you get from A to B, but we're not the guys manning the ship. We're spectators at best. And so it needs to be a true partnership. It needs to be a true partnership where the team understands where they're going, and we as investors bring sort of a macro view that then aids the team to actually get to the objective that they have defined for themselves. And if that's all in sync with each other, I think you have a winning formula. If it is not, unfortunately, you will at some point stumble and falter along the way. And that's really something we place a lot of the scrutiny on. So is there an understanding of the objective? Is there an understanding of the technology, which there is, and the path for getting from A to B? And how can we as investors really be helpful in that journey?
Thank you, Edward. Going to the second topic, this is a question that really I think everyone asks to themselves. What makes a startup a unicorn from day one? Because the reality is that many startups for venture capital, when a startup approach a venture capitalist, venture capital feel that it can be actually the good one. But what makes the difference? What makes a startup a unicorn from day one, Francois?
So a few elements that are critical, and I'm going to back Edward on this again, that there are plenty of great businesses, not good, great businesses that do not require a tech VC in them or supporting them. If you look at the total number of IPOs, US or pretty much anywhere in Europe as well, you're going to find that around 3/4, 74% of IPOs are not VC backed. 3/4 are not VC backed. So I blame the press for a lot of issues that we see. It seems that today, an amazing business generating strong cash flow, growing on its own, it's not worthy of PR or respect, or the entrepreneurs just haven't made it. And I've got a big, strong thing against it, because if you look at what it means for the entrepreneurs and the founding team, the outcomes are massively better. Again, some of my best friends are venture capitalists. Both sides are needed. The type of company that requires it is different. So let's go back to the question now, which is what makes a unicorn. It's relatively simple math. It's going to be your progress times your industry or sector average forward multiple. I repeat that. It's basically where you're at in your growth, typically number of customers and projected revenues times the average of your industry. Some industries attract super high forward multiples. Typically, enterprise SaaS will have between 30 to 50x forwards, and some others don't. back to these e-commerce companies or some consulting companies where you're going to be pretty much valued as much as your last quarter or your last yearly income. There's zero forward multiples on a consulting business. Same for media groups. Great media agencies doing some outstanding work with their Coca-Cola clients and the whole typically will be a 20% profit margin business, will be valued at up to 1x revenue. So that's the answer. When it comes to a unicorn, absolutely the wrong metric to take a look at or even consider at any stage. As a founder, you're going to be building an amazing business. You've identified what's called white space, a little bit of a sector that people do badly or they don't do at all. You think you can fill that space with something that's faster, better, cheaper, bigger, whatever the is, and you're going to be the first in that market. And that is a big enough market to return $1 billion. But your valuation, especially in the early days, who cares? Because if you need to raise money again, you'd better have a 3 billion valuation on the next round. Otherwise, these investors are going to do a down round. And guess who pays for the down rounds and the down valuations? Not the previous investors. It's going to be you guys. So start with a valuation where everybody follows you, wants to invest again, and have a valuation that pays the guys from the last round. Otherwise, you're the one paying for any blip on your projections. Sorry, it's a long answer, but I hope it gives you a view.
So Francois, I should invite you next time I do my guest lectures at university because you're hitting all my talking points.
Sorry, shit. I'll shut up. Promise, I'll shut up.
Edward, please.
No, maybe to start with the last thing, I have this slide that says basically you don't want to build a house on quicksand, and that's the valuation question, right? Because ultimately you're going to be the one holding the bag. But that aside, I think that what makes a unicorn, again, for me, it is a question of what do you want to achieve? And if you dive into the revenue multiples that Francois described, the question is, why do people pay revenue multiples? There has to be some reason for that. And the reason is there's an implication of potentially, future growth. And that leads us to the different types of businesses. So in my simple mind, you have 3 types of businesses. You have existing technology, new channel. You have new technology, existing channel, and new technology, new channel. And there is a different multiple attributed to each. And that, of course, times the end market in which you're serving. Now, the most sort of like sexy quote unquote is the latter, new technology, new channel. There's complete blue skies, but it's very hard for people to price it because there's no idea of what this could be, how you could actually see any of the multiples, attributed to existing players, because there are none. But that's where the highest upside lies. And that's personally where I'm most excited about. And where I think that venture capital is actually best deployed, really swing for the fences. Now, if you think about existing technology, new channel, Netflix, for example, great business, but there you're confined by sort of like the multiples of the industry. And, people can extrapolate whether this can scale geography or content-wise, so horizontally or vertically. And that's what you're bound by. And that's where the multiples come from. So again, these are just things to consider. It is not a good or a bad. These are things to consider in your journey, and therefore what you think actually evaluation that you're asking makes sense, and how you can, sustainably build this journey that you're embarking on together with your investors.
Thank you, Adam. Stephanie.
Well, I'm going to talk as a business angel, obviously. So for me, what is really important is groundbreaking innovation, something that has never been seen before, but it has to be a simple solution to a complicated problem. That what I like to say to some of the startups, the solution need to be simple and being explained as simply as possible. Then obviously high technology, privately owned, because we don't like when there are already a lot of people involved in a startup, at least at a business angel in my level, and something that is obviously consumer-focused startup that has a consumer in mind, how to make the life of the consumer better and more, consistent and simpler. So that's what I would be looking at.
Thank you. Jonathan.
There's obviously, in addition of what you've just said, there are issues of addressable market, and there are very interesting technologies and companies, but that are living in a market that is too small, or the traction and the potential is not there to generate unicorns. And the second point, it's the geographies. Most of the unicorns that I know, they are addressing either they are US companies that are addressing US or China, very large geographies. But if not, they are looking to the entire world as their target market. And it's something very interesting difference that I can see between Israeli startups and startups, for example, from Italy. So very often you came across a company that want to solve a problem, want to address the Italian market or maybe 2 or 3 European markets and so on. It's very difficult to generate a unicorn in those markets. Israeli companies, on the other hand, think globally since day zero. So one of the things that you can see, they maybe have 2 laptops and a desk, but they're already thinking globally. They're already addressing every possible market and approaching international players, international customers, and so on. And this is definitely a key. For sure, there are industries where it's much easier, thinking about cybersecurity, thinking about fintech, thinking about the SaaS and so on. Definitely, there are a lot of companies that are solving huge problems in the medtech domain or in the pharma and so on. But there, generally, the size of investment it's much larger, and it's not so easy to get the VC returns.
Thank you, guys. I want to add one question to this topic. How important is where the startup is, the founders are? I mean, I would say if your startup is based in the US, it's easier that you become a unicorn because there is much more money than Europe or maybe Africa. Francois.
So sadly, I see a huge disparity between different markets for relatively similar businesses. So one, remember, go back to the team. They are just less experienced repeat entrepreneurs in certain parts of the world. And I think Southeast Asia is an example where the markets are enormous. The fastest growing middle class, $12,000 and up per year, are in explosion mode. Everybody wants to buy certain goods. But these companies really struggle with their valuation compared to the older and the fatter continents of Western Europe and the US. Again, I struggle with the view that you build a business to achieve a particular value or valuation. I think what you need to look at is, in terms of how can this become really big, you need to look at what you're capable of acquiring as a customer, region, particular sector in your non-Western Europe geography, because typically what you see in those continents is massive M&A deals. And that is going to be no longer about the value that you drive, but the share of wallet or the percentage of market share that you can control. And there is how you get a very high multiple on forward valuation, on forward revenue you haven't got yet. When a large, back to the e-commerce example, if an Alibaba buys you because you control 20% of the Nigerian market for particular products. So you need to shift from I raise big and I become the dominant company based on a multiple of revenue, and you focus on who am I super valuable for if I control 20% of the market. I hope it's helpful. It happens a lot, right? Secondary countries do best not out of raising big and going all the way, but at being the very best, either copycat or the number one in their markets, waiting for a larger, better funded company to buy them.
Edward, what's your take?
It's a sad thing that is true, and it shouldn't be. It shouldn't be the case. I mean, especially if you think about quality of ideas or anything like that. But the reality is, geography does matter, and I agree with everything Francois said, so I won't regurgitate that. But there's another very, very important factor which is not being considered. Investors like us raise money from limited partners. Limited partners impose certain restrictions on us. They will impose restrictions such as, if you take European investment funds money, which is the largest LP in all of the asset class in Europe, that 2/3 of the capital of the fund has to be deployed in mainland Europe. And so as a consequence, your sleeve for going outside to sort of like exotic locations is very limited. And therefore, it is a much higher bar to clear to actually do an investment that sits outside. Because in that outside pocket, you have, in my case, the US, Sub-Saharan Africa, Southeast Asia, but also random places like, maybe Switzerland even, because it's not part of the European Union. And so which one are you going to choose? And where is the risk the lowest and the upside the highest? And that's really why I think the let's say, less accessible regions are struggling. And so a very simple solution to this is relocation. And it's not always an answer people want to hear, but it's just, making sure that you tick a box and that you de-risk essentially the level of access to investors that otherwise would simply be an unsurmountable hurdle. It's not the only, I wanted to highlight that one.
What's your point of view, Jonathan?
Well, adding to what Edward just said, I'm seeing quite a lot of startups with international teams, and COVID accelerated this trend. So it could be, I mean, in Israel, we are doing that for many years because, again, technology is here, but the markets are abroad. So you will find a lot of startups that at a certain point, they relocate part of the management or the sales and marketing and so on. But they can then also incorporate in another country, maybe in the States. Very often, US funds are asking that. So probably a good idea for startups emerging in other countries would be to locate part of the team, if not relocate the whole business, at least part of the team in other countries, because maybe the market it's also not where they started. So this is something that I believe that after COVID we're gonna see even more.
Stephanie.
Yeah, I agree with what everybody else said, to be honest. And sadly, the location is very, very important. And sadly, what's happening is most of the time the brands are brought to the US. You can have an amazing funder in Nigeria with an amazing idea, and because the idea is amazing, he had to relocate and explore more and do more research in countries like the US and in Europe and Asia. So location is very important for funder startup to scale. And yeah, and that's it really. But I was talking as a conscious, obviously, of the conscious investor, where in all fairness, all ideas and startups should be developed in the countries where it's coming from. But it's so difficult. I'm talking in a country like, let's say, the Congo, for example. If you have a new technology today that does X, Y, Z, it would be very, very good for that funder to find funds and to develop and to scale up. And unless they have investment from around the world. But even if you have investment from around the world, you need to relocate. So it doesn't benefit at the end of the day to the country the funder is coming from. Again, I'm talking like a conscious investor right now, and it's a big issue that we're having in the world, but it's a reality. Location is very important. You have to be where the money is.
I think I agree with what you're saying, Stephanie, but I also don't want people to get the impression that, everybody needs to relocate to the US. That's
no, yet. Indeed, yeah.
If you have a benefit for being in a certain location, there's a bunch of health tech businesses in Singapore that are doing phenomenally well. And they're really the only ones collecting data in a particular sub region of the world. I mean, that's valuable. There's a reason to be there. And therefore, you can clear those barriers. It is more like, it depends therefore on what market you play, what your exit ultimately is going to be like, therefore, and how you want to construe that path. Because it is very hard if you think about staying a standalone business in IPOing, and you're a company out of, I don't know, let's say Southeast Asia. That's a harder place to be than if you're, for example, targeting an M&A path like Francois was describing before, and your value is really derived from the fact that you have a local presence.
Yeah, I totally agree with you. And thanks God, there's a lot of fairs and events organized around the world to give visibility to those startups indeed. But there's still little tiny countries that are not heard. And I'm more talking about them. Of course, Nigeria is more like Nigeria, in fact, Kenya, to talk about Africa, are really well seen, but they're still, or South Africa by the matter, but Senegal, Mali, and has no visibility in the world right now, or Malawi, then yeah, but I agree, it's becoming better, which is amazing.
Thank you. I mean, let me go to the topic. So there are startups who very much, I mean, fundraising is difficult, it's very complicated, there is nothing to do. So many startups try to raise funds between angels and venture capitalists, but the reality is just few get the money, the rest just say get no. But there are startups who really struggle to get 100K in funding. There are others that pretty much takes 100, 200, 300 million with just an MVP or pure idea. Again, what's going to make such a huge difference? And also here, how do you really understand evaluation when it comes to just an idea? Francois?
So I'll split the question in two. What makes the difference, and also do people know the valuation?
Yeah.
Typically, what you're going to see, and it comes back to the first question, a team that has a large component of the senior team having been there before, ideally having failed once before, so they know how difficult and hurtful it is. And something else I hate about the press is this fail fast concept. Oh, it's fine, you fail, you close down, and you restart a new company. Yeah, bullshit. It really hurts when you have to go back to the people you promised that you were going to carry them and go all the way to the moon with them. And you've taken their money and then you've lost everything. I've been there. It is not how it reads at all. So somebody that has been there, done and will never fail again, at least not on the same basis, because that mistake is so costly and so painful, is somebody that has a great asset. You can't monetize it. You can't put a price on it. But you know that when it comes to the second time, this entrepreneur is more valuable than one that hasn't seen the pitfalls, the potholes, and the traps that inevitably will face you along the way. So quality of the team will drive the valuation up immediately, especially in the early stages. Remember, you take a snapshot today, you have 3 companies, there's going to be less than one that makes it after 12 months. So super high death rate. How do you minimize death rate? You get the best team that you can afford as an investor. The second thing is, how do you know? And how you know is going to be I'm super generalizing because of sector and sector multiples, is what is it that you do? We are talking about startups like they are cookie cutter, same old. But if I am working on a new type of nuclear fission technology, that will take me hundreds of millions to get there, but the market is in the trillions. So some, very few, like intellectual ventures, will go beyond the classic fund, 10-year fund, 2 years extension, maybe if you're lucky, after which they have to sell and get the money. So different sectors and different technology components and levels of complexity will drive a way higher valuation, simply because the capital requirements is going to be that much bigger. So do not equate valuation or the size of a round with what actually comes into the pocket of the founders. There's another huge misconception. You see this big announcements, company X raises 800 million. I promise you, this is not going to be an 800 million equity round with a fixed valuation. It's going to be highly complex structures with a whole bunch of if and then, some secondary, take out the friend, family, and fools from the beginning to clean up the cap table. Quite a lot of debt, some debt based with a percentage that will be variable based on performance. You get the idea. It's not an 800 million. Here is a check for 800 million. So A, which sector are you in? 2, don't compare, just do your own thing and look at your sector, because nuclear fission, clean coal, clean concrete, clean stuff is always going to be valued at a higher multiple than your software business by default. More complicated, more costly to come there. 3, don't be fooled by the numbers, because they're always lying. Typically, unless you're at the early stages, the numbers don't mean anything, and nobody will tell you the truth that if any blip happens, it's the founders paying for it.
That's the brutal reality of venture capital. There's nothing to do. We can't cover behind it. That's the reality. But who works in venture capital understand perfectly that with this. But when you are a founder starting today, that's another word. I mean, they believe they come, they get some money, they become billionaire the day after. But that's not the reality. Absolutely not. Jonathan.
When talking about valuation, most of the people think about it as a bilateral negotiation, and indeed it's a multilateral negotiation all the way. So how you price something, it's the market, it's the free market. And it happened to us quite a lot to be ready to do an investment at a certain valuation. And the day after the valuation just was some different figure just because someone else was ready to put on the table a term sheet at a different valuation. And that's perfectly fine. So the truth is that when you have those stellar companies, like Francois was mentioning, with some kind of core competencies and people that already failed once or twice or 3 times, and hopefully are gonna do different kind of mistakes this time. But seriously, also people that are coming from very interesting companies. We are looking here in Israel, for example, at a lot of entrepreneurs coming from large corporations that managed huge operations and then moved to the other side of the fence and creating new technologies. So in all those cases, basically you are competing or competing and cooperating at the same time with other ventures other VCs that are ready to back these kind of companies. So the more a company is interesting for the market, the more you will find maybe larger VCs with larger and deeper pockets ready to invest in this company. So the truth is that going back to your question, some of them will struggle to get even angel grade investments. Probably there's something to do with the technology and the team, and that's life.
Stephanie, although you are seed very early, what do you think about?
Okay, then I completely agree with the skills of the team because obviously the best people in place, the better is a company and the better is a strategy and the better the company is dealt with. So the team, 100%, where they're coming from, where they worked, who they worked for, their experience before as well. So again, I'm repeating, how scalable is the startup as well? That will help. Is the market big or not? Is it niche? The scarcity of the product they're offering or the service they're offering, that will help to know if the valuation can be higher than what it is before or justify the valuation given. So that would be, for me, the 4 different reasons why a startup will fail or not, or will struggle. And obviously, I also like the fact that there's proof, proof in terms of if there are some requests, if there are some demands, are they already in contact with some retailers? Is there a real need on the market right now? So again, it goes with scalability, I suppose, and the market size.
It's very complicated. Edward.
I'll try and keep it short. It's risk versus reward, man. That's it. And everything that has been said can be plotted along that line. If the reward is vast, like with the nuclear fission example, and there is a high risk to it, you have a valuation that reflects that. And it's with a founding team that, for example, has already learned their lessons. They're de-risked. There's a fund, investors like us who are early stage investors. We also have a funding risk. We need to, at some point, get more capital in order to make sure that these companies go further. So everything that has been said can be plotted against the risk versus reward line. That's it.
Thank you, Edward. Albert, I would like to welcome you. I think you're right.
So it's I've done a couple BA investments in the last month. One in Barcelona for B2B SaaS, and one in Bogota, which was basically quality inventory brought from Asia to Colombia and then to the rest of Latin. The first already had traction, had a very strong funding team, but we closed 150K round at 1.75 million cap because it was a convertible. The second one, the one in LATAM, we closed 2 million round at a 10 million conversion. And it basically, they almost didn't have an investor's deck. So it's very much dependent on the momentum, on the location you're based at, on the background of the founders, and also sometimes, and it shouldn't be like this, but it is more and more, it's the fear that some investors have of missing out on the opportunity, which is very tied to what Edward said about the risk and reward. So sometimes you see an opportunity and you see the capability of that founder to raise a subsequent very large round that gives you the idea that you can actually make a huge return in the next years, which gives you that fear of missing out. And, you know, I believe it was Jonathan was mentioning this. If someone comes with a term sheet with a high valuation, then that FOMO continues increasing. So you continue, building up the inflation in the rounds. So it's very on a case by case basis, and it all comes down to what Edward said about the risk and reward. If I think these guys can raise a subsequent round and that they can find a space in the market that they're trying to work and it's just scalable, and someone will come with a good multiple for the fund, every fund is going to accept a massive valuation, especially in the context of massive liquidity in our market right now.
Thank you, Albert. Let me say that FOMO is driving up a lot valuations today. We can see the tech sector in US, FOMO is absolutely crazy. You have 100 times your revenue. It's absolutely, but anyway, let's see if this is a bubble or not. It's not to me to say that. We will see. Now, I really would like to talk about IP, intellectual property. How it's important that the IP belongs to the company, is developed inside the company and not outsourcing. I've been talking to many startups, and many of them, they misunderstand this point. They believe they can actually outsource the IP, they still having a good evaluation. Anyway, we always talk about inside the venture capital rule, okay? Francois.
I'm going to be controversial again, but I might politely disagree. Let's put it that way. So there's two ways to look at this. The first one is to say IP is critical, especially if, like Jonathan, you buy something that is complicated to do, is defensible. They call this the moat, something that is difficult to copy, engineering-wise heavy. So think of it as, advanced security, military technologies, stuff that is in the hard-to-do box. You need to own that, not just use somebody else's, because when you sell the company, you don't sell it on the basis of your revenues or multiple of revenues in the future. You sell this by its exclusivity value. Remember that there are now funds, US military is well ahead of the game, buying technology to take it out of the market so that it becomes theirs and only theirs. Huge value on this exclusivity, because technically they're taking you out of the entire world market. There's a price for that by you not being able to sell it elsewhere. On the flip side of that, and that's vast majority of software companies as you know them today, the opposite apply. There's been so much focus driven by lawyers, obviously, to secure some IP. When you look at it, technology-enabled services have been producing the biggest returns lately. Is Uber a tech company? Is it? We have two sides to this. Is Airbnb a tech business? It's certainly valued for it, or as one, is so you get the idea. They are outstanding services that are being built increasingly with low or no code. I'm sure you know about these new platforms, which allows anyone to become a developer, use a logic map, and translate that without having a heavy and expensive army of developers into a working prototype, an MVP, and then a live product. And that is becoming the new trend. So should I be a tech company if I rent secondhand hardware? Should I have a tech IP platform if I do borrow my doggy, service for dog owners to find, kind people to walk my dog? Amazing business, $60 million in New York alone, fantastic businesses. Valued like tech, no real tech. So I would challenge that if you want to be a tech and you need to own the IPs, it's really difficult. Otherwise, don't focus on your tech stack and your army of developers and burning cash. In fact, there's a fantastic business that I'm getting involved with, which buys secondhand code. Remember, Europe alone, 1.6 billion euros get spent and wasted. 90% of the companies don't make it. Usually, in particular in Europe, because we're great engineering, we're lousy marketeers, that technology ends up on the hard disk of the CTO of the defunct company. And I want to go and buy this, republish it, a little bit like a code sharing and code licensing. You've had this for websites, you've had this for scripts, you've had this for graphics and picture images. I believe there's a huge market in Europe alone, even bigger in the US, for secondhand code. You're a startup, you only have 200K. Why on earth would you try and hire an army of 5 engineers? They're going to be shit because the good ones have been taken by the companies with much more cash than you. So go and buy the code that you do, which is enough to get to your MVP. Don't focus on the IP until you're way down the line and you start going international or Chinese markets or other markets that don't respect IP at all. But I would have, there we go, that's me.
Always controversial.
I'm a therapeutics guy. I'm a life sciences guy. And there's a different paradigm there. And I think the question we should ask is, why does IP exist? And it exists for a reason. Intellectual property and the granting of IPs exists for people to take risks, to develop something, and to ensure that if they're successful in these highly risky endeavors, that the reward is there at the other end. And so if you're thinking about where is venture capital best allocated, it is best allocated in companies whose technology can be de-risked quickly. And so in the consumer tech world, it's very simple. You throw something at the market, you get quick feedback, and you see which horse to back. Now, in, for example, the life sciences world, where the average time to develop a molecule is, north of 10 years, you are never going to commercialize that molecule yourself. There's not even venture capital enough to build a company, to build all these go-to-market channels and basically create a new pharma company. That's why pharma companies are basically marketing agencies at the moment. And so you need to be rewarded for that. You need to be rewarded for doing all that heavy lifting. And so that's why these companies will transact based on an area under the curve up until a point of patent expiry. That's why patent expiry is important, because without that, there would never be a reward for these guys to actually do this. And we would not have the vaccines right now for COVID. We would not have all these therapeutics. And so it really depends on which area you look at. If you look at nuclear fission, for example, there will be something in that whole technology stack that is important to patent. Otherwise, nobody will embark on this endeavor. And so for me, it is very important to question, why should IP exist? And should this particular technology have IP or not? And to your point, Francois, I mean, if you think about Uber, really, there shouldn't be any of that code that's patented. I mean, it's all off the shelf. I agree with you completely. But again, for therapeutics, for nuclear, yes, there should be IP, because otherwise nobody will ever do these things.
Albert.
So yeah, I completely agree with Edward, and of course it basically comes down if you're betting on technological disruption or business model disruption. If your disruption comes from business model, and it all comes down to the value add that you're trying to get to the market. If you're a tech-oriented company with technological disruption, I think IP is key, and investors are going to value that, because if you have it in-house, no matter we can take it from what Francois was saying at the beginning. Maybe for the start, you can actually get the second-hand code and then grow it up. And once you start getting traction, you start building up on what you actually acquired at the beginning. But it's going to be key that you have it in-house and you have it patented and that you have an actual internal IP that is your asset and that investors are going to value, because that's going to be the differentiator against your competitors. If you're focusing on business model disruption, it is far less important, and it actually gives you flexibility. If you find new tech that is being developed, that it can actually, help you be more efficient and get better to the market, get better to users. So having that flexibility of being able to change from one to the other, not owning it in-house, I think it's actually good, because you focus on your core competence and the core things that you want to bring to the user and to the market. So very much, you can see it from a very, from a case-by-case basis, but I think it very much depends on what value you're trying to bring in, whether it's business model disruption or tech disruption.
I should have qualified early stage, right? We're talking about early stages here, not companies that have raised $1 billion and have 200 million to protect in China and stuff. But when you raise 250, do you want to spend 20 grand, which will be the minimum you have to deploy? Do you want to spend 10 to 15% of the small monies that you have? Not in the early stages.
Makes no sense. I completely agree. Jonathan, what do you think?
Well, short answer: no IP, no party. But really, it really depends. And my point is the question is, where is the value creation? So if what you are building, it's indeed the technology, and this is what one day SAP, Oracle, or Intel will come and buy, so you really better protect it. And the same goes with the anything which has to do with pharma and medical devices and so on. If you're building a cash cow, or if you are just approaching a B2C market, and you're one day you will sell or IPO cash flow at the end of the day. So definitely, it's not mandatory for you to have an IP. But I think that there is also a timing issue. What Francois was mentioning, it's extremely important. Even in the no IP, no party game zone, I'm not sure that you should allocate half of your pre-seed round to the IP. There are a lot of things that you can do while managing the IP process. You definitely need to have in mind what are you gonna do and when with the IP that you are generating, and it could be that you can postpone some of it to a later stage and to do some kind of proof of concept that will not impact the possibility to patent what you are doing. So there is an issue on timing, which is for me extremely important. Sometimes we say to our companies, okay, we will definitely have to deal with the IP. We'll do that later.
I agree. IP is a very big question. Stephanie, do you look at IP when you do
well,
your
I think everything has been said, but realistically, yes and no as well. It really depends what sort of company it is. You know, a company like Dyson, for example, without IP, I'm not quite sure about that. But Uber, Lyft, and all those startups, back then, I'm not sure it really matter. So it depends which stage, the timing as well, and the type of company. Are they innovation focused, or are they people focused? Where are they? What do they want? And what sort of valuation are we talking about if they had such patent? And is it commercial? Like, can it be commercialized, in the future? And again, I totally agree with what has been said before. Pharmaceutical companies, of course. My God, yeah, of course. But there's companies that have no point of doing such.
I would say it's also very complicated to defend an IP. It's not an easy job.
And it's long timing. Like, it's really long to do. It takes a long time.
Thank you. We have one more topic, and after we can read some Q&A. And this is the question. 2022, we are in February. We get started already. We are close to close the Q1. What's going to be the hottest sector? Where you think the money is going to go, Francois?
So obviously, every investor here will have a massively different view. I think overall, and I'm not going to use my own personal opinion, I'm going to try and get some hard data instead. You're going to see three big trends. One is, and Europe is fueling this massively, all of them actually. One is going to be a return to what they call deep tech, complicated stuff to build. And you see now funds being specialist and dedicated only onto those. So think of, trying to keep our European data, financial data, health data, insurance data, keep it within European servers and European businesses instead of giving it away to Americans. We've seen that movie. We know how it ends. They're not exactly serving our interests if you give your entire data to the GAFAs. The second thing you're going to see is health, and the entire supply and value chain is being changed. And you see, obviously, again, the GAFAs realizing that it's a multi-trillion-dollar sector, and Europe has a huge amount of opportunities, but also risks attached to it. So Europe is now funding several funds to be at the front, at the bleeding edge of technology in tech. And frankly, we all know by now that we're going to have, our parents are going to live healthier, but more longer, and therefore are going to need to be adopting a path to preventative medicine. It's pretty clear we're not going to get sick, go to a doctor, or the doctor comes to you, you go to hospital, get treated, and start again in that loop. This is over. It's going to be highly preventative. Who's going to win this? And the third one, I would say, is the use. We're at year zero, ground zero, so don't read all this bullshit at the moment, but look at everything that will become decentralized. So forget DeFi, forget finance, Bitcoins, blockchain, trading, NFTs, and all that. Although we're reaching now roughly $1 trillion, I think $1.03 trillion worth of the entire asset class. I think what you're going to see is the adoption, which you see, news trickling along, because it's not cool, it's not hip, but this is where the real massive market adoption is. It's going to be used by corporations that do not have trust. Yeah? A trustless society. You can think of the US and China, you can think of India and Pakistan when they trade, huge issue about trust. So having a meaningful way of trading with a non-trusted party is huge, especially in corporates. I've seen radical examples in the maritime industry where the insurers do not trust the people who own the boats, who don't trust the people who operate the petrol tankers. You get the idea. There's plenty of business which has to be made out of contract or contractual relationships that cannot be controlled by one party. And that is, again, a multi-trillion-dollar industry. So applications, I don't believe that we are smart enough, at least I'm not, and plenty of my peers are not, in defining what is the next platform or what is the next ledger system. But there's so many opportunities in sector by sector to change the rule book about how you trade efficiently. And I think that's going to be a super strong investment vehicle.
I do agree. Edward, where are you going to put your money?
I'll keep it to the stuff that I know, which is healthcare and life sciences. And there's three major trends happening right now. Artificial intelligence combined with a once-in-a-lifetime generation of data allows us to really change the way we're practicing science as a whole. So science traditionally has been practiced in this very reductionist way, where we take very complex problems and we break them into individual pieces, and then we try and infer those pieces. Now, the next big frontier is, can we actually extrapolate our findings in those individual pieces to understand the complexity of the whole? Now, let me explain what I mean by that. In human biology, for example, we've always looked at, let's say, what an individual cellular response would be. And then we try and stuff a drug into humans and we kind of hope for the best. Now, for the first time in history, we can actually regard human biology in all its beautiful complexity. And that's going to be a game changer. It's going to change everything around, instead of having to brute force our way through generating hypotheses just by, sheer luck, we can actually look at population-wide data sets and infer hypotheses that are so much more specific that we can actually change the complete, the complete system of healthcare as we build it. So it's AI in healthcare. It's going to be multi-omics, which is basically all the omics, so genomics, proteomics, all the different signaling, all the different executive functions of the body on a cellular level. Think of it as the source code of health. That's something we can now comprehend and actually modulate and play with, and gene and cell therapies. Those are the big things for me.
Thank you, Edward. Albert, where are you going?
Just building on what Edward says. So one thing that I've seen, especially for AI and ML models, is when you put garbage in the model, you get garbage out of the model. And most of startups are centered around building extremely good models, but not around the data that you put in those models, especially when it comes to private data. So I've seen very good cases of synthetic data generation companies, which basically are companies are able to generate data sets that preserve the statistical properties of the original data set, but without being masked data, meaning so no one can actually get to the original data set because you just create a new data set that preserves the statistical properties. So that's one thing that I see as really interesting. But again, because everyone looks at the sectors that, he's from the mandate, you actually have to look at that. I'm very focused in impact. So anything that is impact related, from health tech, climate tech, and anything related to generating an impact in society. One thing that I'm very, very hyped about is a thing called, so not only nature-based solutions, but natural asset companies. So there was recently an article from Kipling there that said that the New York Stock Exchange is accepting NACs, so natural asset companies, to be listed in an exchange. Those companies' values is derived not only of the cash flows that you can generate from the activities that company conducts, but also from the externalities, the positive externalities that the company generates. So anyone who becomes an enabler of these kind of projects and breaches the financing gap that has to come from the private industry to get into those sustainable and positive impact projects, I think that's going to be a massive trend. So we've seen it, for instance, with the case of carbon sequestration, with the case of wildlife conservation, of anything that can generate an impact in land ownership. So I'm very, very hyped about that space. So very, very close to climate tech, basically, and within fintech edge.
Thank you, Stephanie.
I'll try to say something that nobody said before. ESG, I think, would be one of the things that we will need to focus on. When I say environmental, societal, and governance, I think agriculture needs to be dealt with and improved. Water, we have water issues all around the world. This as well, we need to work on new technologies on that. Pollution, environmental issues, we need to work on more sustainable ways to live. So I suppose that all those new tech, all those new startups working on those issues around the world would be my focus as far as I'm concerned. Then AI, obviously, our lives are improving all around the world, and we're doing better things every day in terms of health, in terms of working, in terms of every industries, including social media right now. And I believe in NFT as well. Not only what is being done right now, but there's so much more to do, like in music as well, not only in painting, like music, writings, books. I feel like this part hasn't been explored as it should be as now. So NFT, ESG, and AI, that's what I said, are the three that I will opt for.
Jonathan, the last is yours.
I think that all of us agree about the centrality of data in the next few years. But maybe we didn't talk about one of the big changes that we are facing. Until today, the order of magnitude, the size of the net was basically a function of number of people connected. So if you take just the population of countries with regular internet access and you multiply for the number of devices connected, and this is mostly the size of the net, and the data is correlated. Today we are facing an exponential increase in the number of objects connected to the net. Internet of Things, and in a few already today, but in the next years, the number of objects inside our homes that will be connected to the internet will be exponential. So the order of magnitude of the new economy, the internet, call it whatever you like, will be no more related to the number of to the population indeed, but the number of objects, which is many order of magnitudes greater. This generates huge amount of data, which is substantially larger than the size of the data that we are used today. And this generates incredible opportunities in terms of matching between different sets of data, different sources of data, and different domains. I've seen companies that have started their journey in building algorithms in the cybersecurity domain, and they realize that their set of data has a huge impact in fintech, in the algo trading world. So you will see overlapping between different sectors that you didn't imagine just a few years ago. You mentioned the healthcare data. Obviously, the intersection between those data and the insurance and the fintech and insurtech, it's huge. And the same goes with autotech and artificial intelligence for cars and insurance and fintech and e-commerce and so on. So the intersection between different segments, it's gonna be really huge. So I will leave you with something that they quite often say to my LPs. Besides the domains where we are investing, so cybersecurity, SaaS, big data, and so on, I would rather have a few silos which are empty at the moment, meaning that I don't know yet how to call to those technologies and domains. But once I will see them, I will probably hope to recognize them, and maybe we'll find also some kind of name for those new stuff.
Thank you so much, guys. Let's try to answer some questions. There is one, can summarize a few people. Now, there seems to be a general hate for e-commerce. Hate is a bit too strong, but e-commerce platform. What a platform that like the LinkedIn of business, where business can find, buying, and sell products and services. Will you invest in that, Francois?
Yeah, it's called Alibaba. So either you guys are going to be coming up with something new, or you're going to have to tell me why Alibaba is not going to eat your lunch. Yeah. So two things in that. One, nobody hates e-commerce, but venture capital hates e-commerce because typically it does not give them an exit return that is as high as other more complex technologies which haven't been done before. So entering a space where you have giants like Amazon, Alibaba, eBay, and the others, thinking you're going to be differentiated and your cost of customer acquisition seems to be a challenge, at least in my view, is very difficult. So e-commerce is fantastic. Typically, as I said, you're going to see if you're good or you have a particular sector angle or a low cost of customer acquisition, you'll be able to grow very quickly. Typically, historically, it's always $2 million, euros, pounds, and you're going to get there, and then it gets extremely difficult. Most of your acquisition channels dry out. So what used to cost you 10 become 15 and 20, and then you run out of acquisition channels. Hence, everybody goes back to become an SFA on Amazon or Alibaba. It's terrible, but that's the way it is. So as a VC return, you end up being profitable, and it's called one of those zombie companies where you grow, but you grow really slowly, uninteresting. The second thing about e-commerce is that mostly those that have VC size returns are turning into marketplaces, and building a marketplace with its two-sided acquisition is a nightmare. You can't have too many suppliers and no customers, otherwise these guys don't sell, they walk out. You can't have too many customers, not enough suppliers, otherwise customers says, well, there's no choice on this platform, and they walk out. So you have to grow like this. Super difficult to do. You have companies like Miracle, if you know those, backed by Felix Capital, and others turning the old-fashioned print magazine into a product marketplace. And these have grown to $1 billion and up valuation super rapidly. And for example, if some of us are listening from the countries, fast developing countries, that's an amazing opportunity that is completely undone. The old-fashioned mail order and catalog companies move them to a marketplace where suppliers can meet those customers. But otherwise, go for revenue-based funding. People will typically, the new funds of funding, RBF, you can Google it, and you will have funds that no longer invest in you and your equity and your shares. They're going to back your cost of acquisition. If you have a high margin business, it's a fantastic alternative to venture capital. They're not going to pay for your staff, your fixed costs. They're going to pay for typically the biggest chunk of what makes your business successful, and that's your customer acquisition. If you have a product that costs you $1,000 to get a client, but the margin on 1,000 is 2.5, 3, 4,000. Think of it like a financial fintech product, a mortgage, stuff like that. It's very difficult for you to have 1,000 clients, because 1,000 times 1,000, it's going to be £1 million in cash. But your margin is so high that you can pay a very high interest fee for the people providing you $1,000. That's an amazing alternative, and e-commerce companies really benefit from that. So think of RBF, revenue-based funding.
Thank you, Francois. It's more related to what Stephanie was talking about, emerging market. Does every one of you invest in emerging markets? Albert?
So not from a fund perspective, so not from So Capital. I have done investments as a BA in emerging markets, yes, and precisely in e-commerce. So yeah, it's something that we look at, but You know, most of the funds in Europe typically have a mandate to invest in Europe, so it's far more complicated to broaden the geographical scope. Yeah, I don't know if anyone, other panelists here actually are.
Central Europe, privately as well. Central Europe is amazing. You have companies that do $1 to $4 million revenue, profitable, and they have this huge psychology that, oh, we're too small. I don't think I could raise money in London. I'm sure my London competitors, who I don't even know, are going to be bigger, better staff than me. I'm not going there. And I see them time after time after time. So Central Europe to me
have
is
very good technical teams, by the way.
Amazing technical team, but it's a psychology job with them. You know, making them show them that the competition is really not that much greater, if better at all. So Eastern Europe is my bag at the moment.
Stephanie.
Sadly not yet. We did have a tentative a couple of years ago, but it was privately. It didn't quite work. It was a hotel in Africa. So it's on hold right now, but nothing presently, sadly. But yeah, maybe 2023. But I'd love to. I'm open to that.
Thank you. Edward, if you'd like to take this one, we already developed our prototype, but because of COVID, we can't raise any fund, and we have been developing further products. What we should do for getting investors as we are working on too many products? Are the investors fear that having a startup working with too many products can make the startup weak?
Well, see, this is, again, I think the question is, what are you trying to achieve? And therefore, what is the question you pose to the investor to back? And usually it's a function of two things. It's time and progress. So the money equals the time, and the progress that you want to achieve with it, that is the value creation that needs to outweigh the cost of capital of that money sitting dormant somewhere. And so what we as investors therefore would like to see is that you achieve a value creation point as quickly as possible. And that is usually best done by putting all the power behind a core capability, a core product, and validating that for the market. And then once it's validated, you have proof points that then ultimately you can scale that further. Now, if you're going broad, by and large, and I'm generalizing here, but by and large, you will therefore take resources away from the speed of execution. And therefore, you're going to be slower or perhaps less attentive to detail, and therefore have either a longer horizon, therefore a higher amount of capital spent to get to that proof point, or you're not going to get there as powerful, as well enough or whatever. And so that's the problem. So that's why there's this mantra of keeping people focused. Because if you keep people focused, the whole team is putting their power behind that one thing that really needs to be achieved. You know, if it's a product development, if it's a commercial milestone, that ultimately then prices in that value that maybe has already sort of like been given to you before. So that's the whole idea behind it. It is the question you're asking your investors is you're asking them for time to execute and time to reach a milestone. And we just want you to get there as fast as possible.
There is one question I really like. That's all the way around. How can we notice that our investors is potential enough? And how can we get connected with their mind? Jonathan, they want to know if it's possible to understand if the investors actually is the good one.
That's very difficult to answer if it's a good one. I can tell you that even investors they have their own LPs and they know after some time, you know, which kind of LPs you want in your cap table and which LPs you don't want, even if they're ready to invest. But again, it's a good practice to talk with companies that were invested by a VC and ask them how's their relationship with them. This happened to us a few times, and we will gladly gave contacts of portfolio companies and to potential target companies and to discuss and to see if there is a fit. But I would like to go back for a second to the e-commerce, because I believe that we somehow we give it a bad stigma. Again, I'm coming from the enabling technology market, so I'm sure I'm biased. There are a lot of opportunities around e-commerce, not about e-commerce operations. There are beautiful businesses. I don't believe they are good for VC. But for example, one of our best portfolio company is a company that developed a technology, AI-based shopping assistant, is generating tens of millions in sales for e-commerce. Or for example, there are a lot of interesting companies in the logistic technologies that are applicable to the e-commerce today, and many others. So definitely e-commerce is a huge driver of the new economy. I would rather focus on technology around e-commerce rather than operations.
Thank you. Francois, I think this is for you as well, anyway. That's a good one for you.
Which one? Do you want me to counter the e-commerce thing? I actually agree with Jonathan. There's plenty of money to be made in e-commerce across the value chain. You know? In certain countries, being able to deliver, forget the 4-hour next day, next morning guarantee, being able to deliver to some of the islands, you know, there's tens of thousands in Indonesia, is actually the value in itself, and that's big enough. So there are now micro delivery, call them chain organizations, peer-to-peer networks being built, which the big DHL, UPS are using. So the entire value chain is enormous, all the way down to the pre-purchase. You know, what is a customer most likely to buy right now, based on the search engine that you can track, based on patterns. Plenty of recommendation engines still make really good money. But too many people think that they can beat Amazon, eBay, and Alibaba as their main thing. And, you know, that's what I'm trying to fight at the moment. The second part,
yes, that's what I like. I do meet the right investor.
Yeah, so there's this common thought, and I think it comes with old age, I guess, but there's this view that you have to please your investors, and you're going to have to get this out of your mind. It's going to be the reverse. There's now plenty of capital, especially in the richer Western Europe, in the US. There is a ton of capital chasing for good teams that have done it before, with who have identified a wide space, as I expressed before, something new, a different angle. So how do you impress investors? Is typically by being yourself, number one, always. Two, having that team that has been through war and came back, and then three, showing that they haven't got a clue. If you think that investors are sector specialists, you're wrong. Most investors have to learn, and who do they learn from? Specialists. And who are the specialists? It's people who are building or have built and have trusted their capital with particular sectors. You know, people who do and practice something every day, especially in very scientific or very complicated sectors, are the ones who know best. And investors are there to support, to finance, bring capital to grow and execute on the vision. But the vision, the knowledge, the sector expertise does not come from investors. So reverse this into back and say, what is it that you have that you're bringing? Obviously, you're going to sell equity, you're going to sell your shares, but think of the opportunity they have to return the fund. Is your opportunity capable of returning 10x, 20, 100x the investment that you're going to receive? And think of how much capital you're going to need. Some opportunities need hundreds of millions before they break even or become a valuation of X. So think of it the other way. How do you impress investors? Is typically by learning how they think and what they need to see. Most of the questions you need to answer are never asked. Most of the assessment, the mental checklist that investors will have when they meet you the first time, will not be expressed. I'm sure you heard about ghosting. You know, the vast majority of answers you're going to get from a selected list of 50 targets that you have, 50 investors, the vast majority of answers are going to be no answers, blanks. So it comes down to you to figure out the process, the position, and the pitch documents that you need, not just the deck. The deck is actually useless. What makes you the company that will return the fund? And then you play a little bit of naughtiness, which I love to do, being the CEO. I've done this a few times. You play on the ego and the FOMO of investors. Let me tell you one thing. If you get the hook and you have the third or fourth meeting with Andreessen Horowitz, you are going to get a queue of investors magically coming to you and say, hey, I've heard about you, I'd love to invest. If you get no reply from everyone, you're not going to get anyone to want to invest and co-invest. Do you understand why? Because everybody every 5 years raises a new fund, typically 5 to 10 years, usually 5. And therefore, what do they have to do when they go and raise the next fund? They want to write that they are investors with the best investors in the world. And that's where the Andreessen Horowitz and the heavyweight funds come in. Sadly, for the small guys, the big guys don't want to share. They make a decision, they take it all. So you getting a little bit of attention by some of the top name funds will almost guarantee you that the funds further down the perceived value chain, that's the ego, is actually going to want to co-invest to beef up their position. The FOMO thing is that everybody, once they've made a decision, very hard, but once somebody that's perceived to be a more prestigious fund wants to invest, everybody else wants to come in, and then it becomes your decision. Hallelujah. That's the magic moment where you have 1 and then 2 and then 3 offers. It's for you to allocate either 3 ways, a third each, or you're going to start favoring somebody who you like more than somebody you don't like. And you're going to have the opportunity to rebalance in the negotiation what rights and preferences go to which. But that's very rare. So at the moment, the question insinuates that you're not there yet. Your number one answer is, what is it that's going to be such a great investment that it makes 10x and more?
Thank you, Francois. I mean, let me close with this one. We can cover quickly because we're already out of time. What are the most important sectors in technology that are still weak at the moment, so they can get in? Edward, if you want to start with this one, quickly, we cover it, all of us.
I don't really have an answer to that. I mean, the best part of this job for me is that, why I'm in venture capital is probably for lack of a better idea. If I had a great idea myself, I would do it. I'm just being presented with great people every day that have fantastic ideas. That's the reason I'm in this job. So I can't give you that prediction. The whole point that I'm doing this is for other people to bring me cool ideas because I'm not original enough.
Thank you.
I love that Dutch humility. It's the closest thing to the Brits. Wonderful, wonderful. I'll come last. I always speak too much.
Yeah, I will leave it 5 works to you, Francois. Stephanie.
Yeah, it's a difficult one indeed. Health, maybe. Sport as well. I think there's not much innovation in sports. I can't recall anything huge that I've seen. So maybe. Or even ESG, environmental issues, how to reduce our carbon footprint. I think those areas are very important and needs immediate action. So there's amazing ideas out there, but it's too expensive. We need a cheap one that everyone in all countries around the world can afford. Of course, we have those, you can absorb all the carbon that, that we have from the cars and everything, but it's so expensive yet. So we need a new idea that is cheap. So we can do that all around the world and reduce the pollution that we have. So I would opt for that one, in fact. And I wish I could bring the solution to this, but I can't.
Albert.
Yeah, maybe because we're also agtech investors, I see massive room for potential in agriculture. Anything enabling, regenerative agriculture, carbon sequestration, or improving farmer operations, improving the amount of light that gets into greenhouses for better production. That it's massive room for improvement. I think that's one of the forgotten spaces, and I hope it's going to bring in good returns, not only because we invest in the space, but also because it's going to be beneficial for all of us. I mean, we're facing massive food shortages, and we really have to tackle the carbon emission crisis. So I believe agriculture needs a lot of technological development and improvement, and it's coming. We're seeing great opportunities in the space.
Jonathan.
There's not an easy answer to this question, but I think something to me it's very interesting that technology revolutionized our lives in the last 20 years, 30 years. On a personal level, on a business level, on the economy level, there's one domain where beside I would say, besides social media and so on, not much was done. And it's the leadership of our countries, politics, if you want. I see a lot of good people that take distances from management of their own countries, because it's so much more fun in the business sector and in the places where technology happens and change happens, and then they stay away from the management of our societies. And it seems to me that we are seeing more and more kind of difference between how fast the market, the technology, and the business are moving, and how, at least in Western societies, the governments and the state is following behind. So I think that we will see probably in the next few years some changes in this equation. At least I hope, because it seems to me that in many Western countries, the distance between the acceleration of the market and the business and the technology, it's unbearable in respect to the politics. Just take blockchain for instance. You have many Western countries, members of parliament, that they cannot discuss with you very simple topics. And when it comes to something which is hard, which is you need to understand, you need to study, and how can they regulate about something that they have no clue? And when it will come also with the management of health data and very, very serious topics. So I hope we will see some kind of investments and development also in this domain.
Thank you, Francois.
I've got two sectors super excited about, because I think most people can do it with relatively small amount of capital. The first one is ESG. By the way, ESG, 81% of the world's funds and fund managers are in Europe. It's the only time in the history of the world where we are actually the dominating force, with more capital, more people, and more cash managers than anybody else in the world. So ESG is definitely a massive industry for us, and we should make use of that capital. Finally, Europeans first. If you've read Bill Gates' new book, How to Avoid a Climate Disaster, strongly recommended. It's super simple, numbers, factual driven, not bullshit and political agendas. You'll see that there are tons, multi-trillion-dollar opportunity, again, in changing the way that we make things. You know, despite what the bullshit you hear in the media, it's not the cars, it's not the battery-powered scooters that are going to fix the environment. It's going to be the vast majority of the carbon emissions come from the heavy, the hardware stuff. So concrete, cement, iron, every form of material, and iron ore that we need to turn into aluminium or copper or anything else needs to be decarbonated. That goes in the air. This is the biggest contributor to carbon emissions. There are solutions with green concrete, green iron, green aluminium, and these are the future where Bill Gates believe if the government starts setting stricter and stricter rules, I believe we're going to see that happen in Europe before the US, then you're going to have a huge multi-trillion-dollar market for cleaner concrete and cleaner metal, which means construction, every single tower block that you see, every single road, airways, airport, everything will become cleaner. Huge opportunity for people to get into the game. Nobody owns that at all. It's still at the research stage. And the second thing I'm super excited about is energy. And we all hear the same thing about the same energy giants all looking and spending a ton of money into doing small things well in a connected way. So you have, wind power, sea, and the other four energy generating forces completely disconnected, charged and receiving funds from central governments at different rates, none of them sharing. So we know now that there's a whole layer of technology that is starting to read how many steps you make with your tracker, how many kilometers you've cycled with your bike, how many mini scooters you've been using, how many times you've taken the train, and finally assembling this real usage of the population together. Weirdly enough, it should be done by the government, should be done by the cities, should be done by anybody but a bunch of startups, but that's a fantastic opportunity because everybody in energy needs that data of the true real use of our transport consumption. And there's a few companies in Greece doing this and Eastern Europe, which are well ahead of the game. I think the big power and large power plants and energy companies will buy them so that they have a true, raw, constant data of what happens in the market. That's my 2 predictions.
I really thank you, all of you, Edward, Francois, Stephanie, Albert, Jonathan. Has been a very pleasant for me. Thank you so much for having this happening, and hope to see you again next time. And thank you everyone for attending this event, and thank you so much.
Thanks for inviting.
Take care.
Thank you.
Bye-bye.
Thank you, Max.
Bye-bye.